We have a quick question here from Jack asking whether the volatility we're seeing right now, post COVID 19, whether we had less volatility before COVID 19, as it seems that the markets are very choppy recently. So thanks for the question, Jack. And yeah, I mean, what we've been seeing recently is just immense in the type of volatility in the market. And if we just quickly take a look at something like cross asset volatility, we can see huge spikes across the board, not only in equities but other asset classes as well, with the onset, of course, of the virus. Now, during times like these, you often see massive spikes in volatility and often lots of disjointed moves in the market. So common correlations work 1 second and then they stop working another, and then they start working again at the next session, and that goes on. And it's not only due to the volatility, but just the immense amount of uncertainty during times like this. Now, I'm sure traders felt the exact same way when they were in the midst of the global financial crisis back in 2008 and 2009, when something like that had never happened before. Central banks had to swoop in and save what they could. And this time around, markets got a whole different taste of something completely new and completely different, because this time it wasn't just a banking crisis but also a health crisis, and that caused one of the fastest and biggest economic shocks that the world has ever seen, with economies literally grinding to a halt, and that on purpose. So I think a lot of what we're seeing right now is just the market trying to recalibrate, but also trying to decide on which side of the coin they want to be. So whether they want to believe in a recovery or whether they want to believe in further downside due to the immense uncertainty. Now, the other thing to keep in mind is that even though volatility was calmer from, let's say, a historical point of view, we still had choppy price action over the past 3 years due to completely different factors, right? So just think back to all the ups and downs, the ebbs and flows when we had the Brexit withdrawal agreement discussions. I mean, it was, pound up one day, pound down one day, pound up one day and down one day. And, apart from Brexit, of course, we had the trade war between the US and China, and trade issues between the US and the EU, trade issues between the US and Canada. The political influence, on the market has grown in the past few years, and it's unlikely that it will, just go away completely. So to some extent, we can still expect some choppy behavior. But the good news is that there is a way around these types of massive volatility shock events. And from my orientation, I'm a very short-term focused trader. And from the onset of COVID-19, what I said is that the way that I'm navigating this environment is in the very short term, from day to day, from session to session, taking advantage of the shorter, let's call it fast money moves as we get the opportunity to do so. Now, of course, it's definitely not ideal from a purely, swing trading perspective, but I think during times like this, with this immense amount of uncertainty and volatility, you need to have a lot of conviction, by looking further out than a couple of weeks from now. Unless, of course, you play the very long game, and then, I mean, you won't even have to bother looking at the short-term narratives. Now, the way that I would advise to navigate this type of chop is firstly with a lot of patience, and then, of course, just very good risk management, knowing that things can go, against you and change very, very quickly. Also approaching this with lots of discipline by waiting for those really no-brainer opportunities where you just know that the market will react, and take advantage of them accordingly. Now, does that make it easy? Definitely not. I mean, trading is far from easy. We already know that. But by only focusing on those key global macro themes, those themes that are currently dominating the market, that will already filter out quite a lot of the chop that we often associate with the markets. And I mean, to your question, what we're seeing right now, it won't last forever to the same extent. This uncertainty will eventually calm down. And once the biggest amount of uncertainty is out of the way, so, looking at a vaccine, for example, once the vaccine is there, once the vaccine is circulated, once that massive uncertainty is out of the way, things should return to, let's call it normal. But obviously, as mentioned, use that word normal take it with a very big pinch of salt in this current context. And be prepared to switch, to the next key macro theme, whatever that might be. Now, for example, we don't know how things will develop with regards to a vaccine. But where we are right now, we're in June 2020. And I can already tell you that in 4 months' time from now, if whatever happens to the virus, there will be another short-term key macro theme making its way into the markets, and that is, of course, the U.S. general elections that is due in November. So we already know that that will be a key macro theme. Now, right now, the markets aren't too concerned with it because it's a little bit far out for them to start worrying about it. But once it starts to, become the key focus, once it becomes that key narrative, that key theme, then of course that in itself can again create some chop and some volatility. But of course, always staying on the right side of the narrative, trading it from a day-to-day perspective. That's usually the way that I prefer to approach these types of things. So always keep the main global macro theme in mind that the markets are focusing on. And that's what I do personally to just try and stay a little bit more focused and reduce some of the I don't want to call it noise, let's call it chop, to reduce some of the chop, at least in the way that we approach the market. So Jack, I hope that helps. Any other questions, please don't hesitate to let us know.